Hey, good morning, guys. Welcome to Market Mondays, coming to you here in Santa Maria, California. I'm actually down here doing some classes for the branch here in Santa Maria. So today we're going to be talking about how the Fed really impacts mortgage rates and what they're talking about in regards to hiking rates in March. And we're going to talk about what that really means. And I'm going to show you a chart in regards to like every time the Fed's made a decision, what's happened with mortgage rates specifically. So before we get started, let's go into a dad joke. Happy Valentine's Day to everyone. So this is a Valentine's Day kind of a dad joke. So it's Valentine's Day, and I was asked out by 5 girls. Turns out I was in the ladies' room. I was being asked out. Get it? Anyway, so we're gonna go right into it in regards to what the Fed, what the meeting says in regards to the Fed hiking rates. So what does that mean? So just so you guys know, the Fed funds rate is what they're talking about. The Fed funds rate does not have a direct impact on mortgage rates. What they're doing is they're trying to control inflation. If you guys didn't know, and I've talked about this a lot, is that inflation has not been this high since the 90s. So that's how the Fed's going to bring down inflation, because it's at like 7.5% on some readings. Some other readings is like 10. It has been, again, and the highest, I think the highest it got in the 90s was 6%, which is a lot, right? Inflation hasn't been this high probably sometimes in the 80s. So it's been a while. So what they got to do is raise the Fed fund rate. The Fed funds rate will bring down inflation. Bringing down inflation would also bring down mortgage rates. That's what we want. And we want the Fed fund rate to go up. Now, the question is, how much is that rate going to go up by? That's the big question. So they're talking about a huge hike. They're talking about doing incremental hikes till July 1st, so on and so forth. So and then at this point, it really depends on intensity in which they raise that Fed funds rate. So keep in mind, anytime the Fed or the media says that the Fed is hiking rates, we're talking about the Fed funds rate. Anything, because the Fed is the only that control that. They can't control how mortgage rates work. It's the same idea as like if the Fed can control stock prices. It's the same idea. They can't. So here's a quick chart for you guys to kind of give you guys an idea of what we're talking about. So the Fed funds rate. So back in late 2015, the Fed raised rates, right? At that time, rates were a little over around 4%. The Fed hiked rates at that moment at the end of December of 2015, and then inflation went down. Inflation going down caused mortgage rates to go down, which is a good thing, right? That's when we saw rates in like the lower 3s. And in fact, I actually bought a duplex in that range too. So pretty good timing on my part. Next thing is that they let inflation kind of rise up, and then the Fed took about another year to hike rates again. Coincidentally, inflation went down and so did mortgage rates. Same thing. Now the Fed didn't touch the mortgage, the Fed funds rate at all. So over that course of time into 2018, rates went up. Rates went up. We're in the 5% range, right? So with rates being in the high 5% range, right? What the Fed decided to do then in 2019 is that they decided to start buying mortgage-backed securities. Then buying mortgage-backed securities caused rates to get a lot better. And then when COVID hit, now just to give you guys an idea, the 2020 recession was expected to happen. The severity of the recession was not expected at all. So between inflation going down because of the COVID pandemic starting off in March of 2020, the Fed also doubled down and started buying more mortgage-backed securities, causing rates to even get lower. So rates were expected to go down in 2020. They just weren't expected to go that low. So with the Fed buying as many mortgage-backed securities as he did, caused rates to get at one of the lowest in history, probably the lowest in history. So, and then the Fed funds was being touched. Now the Fed is trying to taper off, and now the fiscal policy of the federal government was to get inflation back up to like 2% average. And what ended up happening is that now inflation's at almost 8%. So since the COVID pandemic, and the Fed funds rate was zero at this point, and then inflation just kind of took over, and then now rates are now at this point. This is probably about a month old news, but this information is basically now rates are pretty much around right above 4%. So that's what's happening with inflation and mortgage rates following inflation. So we want the Fed to raise the Fed fund rate. As we've seen in the past, every time they've done it, rates have gone down. So, sorry. So just to give you guys an idea on the Fed's decisions, anytime they make a decision, anytime they make an announcement, has a really relatively large impact in regards to what happens to mortgage rates and really just the economy overall. So typically, if mortgage rates are going up, that means people are buying stocks or more volatile investments. And if mortgage rates are going down, I mean, people are selling their stocks and going to mortgage-backed securities and buying them. So it has to do with safety, has to do with how they feel about the economy. So that's what's kind of wild about financial investing. It's all based on how majority of people feel about the economy. Anyway, that's all I got for you guys. Hope you guys be safe for Valentine's Day. I already eat for two, so I don't really need a Valentine's Day. So hopefully you guys have a great one, and I'll talk to you guys later this week.